Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We had a nice little detour here over the course of May, talking about this U.S. debt ceiling situation, which now seems to be finding its resolution. And so we find ourselves coming back even just over the past 24 hours to talking about the bigger picture, the larger story, those things that actually much more influence where we are going in a lasting way around the financial markets. And that is, of course, what's actually going on with the business cycle, what's going on with growth, what's going on with employment, what's going on with demand, those things that actually shape earnings and therefore equity valuations, rates, and therefore currencies and bonds, and what's actually going on with the global business cycle and the demand for commodities. And an excellent time, really, to change our perspective here and look at those things, because we have some excellent economic data that should start to paint this story for us over the coming days. We begin here just with a bit of stage setting to explain what exactly it is that we're looking at and the lens through which we are going to be looking at this data, and then checking in on how incoming figures might influence markets from the perspective of that lens. So, needless to say, you can tell from the title here, the upshot seems to be that there is more pain ahead for financial markets and the global economy. So let's take a look at why that is at a real kind of baseline level. This is a chart that, of course, we look at quite a lot here on Macro Money. This is the 2-year break-even rate in the yellow bars. That's the difference between nominal and real bonds at a 2-year at a 2-year tenor, a 2-year maturity. And you can see it leads by about 2 months realized CPI and PCE. So you can see there that the trend leads, and the implication that it suggests is that, number one, disinflation looks likely to continue. We can see that we have further to go here, even near term. But what the 2-year break-even is telling us broader, in the broader sense, is that in 2 years' time, we're looking at inflation at 2%. What that means is that essentially the bond market is convinced that the Fed will get done what it's looking to get done. What we also know is that we're currently at inflation of between 4.4 or 4.9%, depending on whether it's PCE or CPI that we're looking at. So we're ostensibly closer to 5 than we are to 2. So the key question that we have to ask ourselves is, well, how are we going to square this circle? How are we going to get from inflation closer to 5 to inflation at 2 in 2 years' time, which the bond market is clearly showing us is where it thinks this is going? Now, we're not going to get into, well, the bond market is wrong, because that's reasonably irrelevant. As I love to quote from the great Ira Harris, if you're right at the wrong time, you're wrong. And none of us are certainly going to bully the bond market into doing any one thing or another. So if this is the lens through which markets move, then it's the lens that we have to be using to look at the situation. So the bond market is telling us we're getting to 2% inflation in 2 years, knowing, needless to say, that we're not there now. So there is a disinflationary path that is already priced into markets. And so the natural question is, well, how are we going to get there? How is this squeeze going to occur? Well, it's not going to occur, most likely, from improved efficiency and improved supply chain constraints, because all of that dividend has arguably been paid already. So what we can see here in the blue bars is the Baltic Exchange Dry Index. This is a benchmark for global shipping costs. We can see it's been declining for quite some time, from about the back half of 2021, as we've had more coordinated reopening from COVID lockdowns around more of the world, as supply chains have more so adjusted. Very tellingly, you can see it's been declining from before China decided to jettison its zero COVID policies December of last year. So we see here a realignment of supply chains that's already been bringing down the cost to actually delivering goods. And you can see in the lines there, the red is the cost to distribute intermediate goods, so essentially move goods around the U.S. through the production and value add cycle. So consider, for example, the way cars are built. They are assembled out of parts made all across the world and might then be assembled across multiple different centers, some of them perhaps domestic, some of them perhaps in Canada, some of them perhaps in Mexico. A lot of the parts might come from places as far away as China or Taiwan or Korea, and you naturally pay a cost to shipping all of these intermediate goods from value add center to value add center, where things are finished a little bit more and then a little bit more until they're finally done to create a final product. If supply chains are inconsistent, if deliveries can't be relied on, if there's tariffs, if there's quotas that make this more difficult, if certain things are open post-COVID and certain things are not, all of that goes into higher intermediate costs, which then ends up in higher final goods costs, because of course distributing things from the point that things are done to then wherever they are going to be actually met with end demand. So going from whatever factory to where goods are actually sold at a retail level, that obviously has costs as well. And we can see there that if we look at the year-on-year growth rate for these distributive service costs, they are at this point lower than they were before COVID. We are at this point looking at the year-on-year growth rate in both intermediate and final goods inflation for this distributive component, this supply chain component, just a hair above zero. And so it looks like all of the efficiency that was to be squeezed out from fixing these issues, which were a part of the kind of the transitory, if you will, inflation narrative that the Fed was entertaining as recently as the first half of 2021, before they kind of came to the conclusion that it wasn't going to be as transitory as they thought, that looks to have been squeezed out. And so the question remains, okay, well, this has gotten us from inflation at these highs here around 8-9% down to 4-5%. How do we go the next mile down to 2? Well, the only way to do that seems to come from slowing economic activity. So if fixing supply chains is attacking inflation from the supply side, saying we're going to fix the conduits that deliver supply to meet demand, and if supply is more consistent, then there doesn't have to be as much of a pickup in inflation because this rabid demand is coming up against inconsistent supply that creates shortages. The way that those are resolved is by the end demand competing on the price of things, and so things then become more expensive. Now, the rest of the way seems to be something that has to be approached from the demand side, where supply has been normalized for the most part. Now we have to be looking at, well, how do we reduce demand? And that, of course, is the crux of what the Fed is trying to achieve with this tightening cycle. It's saying we're going to increase the cost to financing every kind of economic activity, be it businesses wanting to hire more people or building new capacity, or individuals going out and saying, I'm going to buy a new washing machine or a new dishwasher, and I'm going to put it on credit, or I'm not. So from the very high to the very kind of local level, everything at this point, all economic activity is facing a higher financing cost by a very significant margin over basically just the past year. In fact, the increase from where the Fed really started to hike, let's call it March of last year. Of course, the markets were anticipating it well before and started to adjust for that way before, but the actual hikes themselves began in March of last year. From then through essentially the subsequent 12 months, financing cost on economic activity went up between 4 and 5 times, which is obviously a huge increase. And so, very tellingly, as you can see on this chart here, global activity has cooled. In the light blue line there is total global trade volume, exports and imports, to kind of get a sense for overall turnover. We're less concerned with whether things are being imported and or exported here. We're more concerned with just economic activity and goods changing hands. And we can see here that there's been a slowdown helping to drive disinflation, very tellingly, from a peak in the first quarter of last year. And so this then is the way that ostensibly we are going to get from 4 to 5% inflation to 2% inflation, is we're going to reduce demand, having basically worked out the kinks on the supply side. And you can see this show up really across major economies. Certainly the latest PMI data that we got out of the U.S. tells this story. And in particular, looking at the manufacturing PMI here, we can see where the drop-off in demand for goods is occurring. You can see most recently that manufacturing PMI number having kissed the 50 level, dipping back under. In the logic of PMIs, of course, 50 is the sort of center line. Above it is expansion, below it is contraction. The further you go above, the faster the expansion. The further you go below, the faster the contraction. And so what we see here in the latest set of PMI numbers is manufacturing in May is shrinking at a faster rate than it did in the prior month, where it was effectively at standstill, and is actually shrinking at the fastest rate in 3 months. You can still see a bit of support occurring here on services, and because services is such a dominant part of the overall economy, we can see that it's filtering into still reasonably upbeat readings on the composite measure. But we, of course, still have the tail from the Fed's tightening efforts filtering into the economy, and the lags there can be multiple quarters in length. So it is unclear, and indeed it looks likely, that this is not sustainable, that we are going to get a turn lower to follow manufacturing on the services side. In fact, the latest numbers that we see from the University of Michigan Consumer Confidence Survey suggests the rollover has already occurred, that consumers are already starting to become more pessimistic in recent months. That ought to hit services demand and see it begin to follow the drop-off in manufacturing. We already see that occurring in other major global markets that make up the bulk of global economic activity. Here's the Eurozone. Notice manufacturing started to decline well before we saw the same turn in services, and thereby the composite index. As most major economies, we have a service-led economy in the Eurozone. So as services go, so too the overall economy goes. But we can see manufacturing is deep into contraction territory at 44.6. And we are just starting to see services roll over to catch up with that. But this is not anything that we wouldn't expect to happen in a similar fashion. And consider the peak in manufacturing, such as it was still under 50, but back in January, we were at a peak of 48.8, almost 49. The rollover here in services is coming as of April. We have the peak, and in May we can see the numbers are dipping. So we're talking about a 3-month lag. If that's something that broadly lines up with what we're going to see on the U.S. side, then we should be seeing with perhaps about a 3 to 4 month lag, the rollover here as well after this rollover on the manufacturing side that we see over the past month. And it's not just the Eurozone. We can see a very similar story in the UK. You can see, again, manufacturing deep into contraction territory at 46.9. The turn in services and thereby the composite index lagged. So you can see here, there's the situation in manufacturing. There's the top. If this then, with about a 3-month lag, is where we start to see the catch-up elsewhere, it would very much line up with what we see here, and what we might expect were we to see something similar, where after this top, then somewhere over here, we'd see these things roll over. It's something that works even more dramatically if we look at China, where you can see, of course, we had a bit of a delayed reaction because they decided to maintain COVID lockdowns much longer than elsewhere. But here, too, you can see there was a surge in services, far outstripping manufacturing, because there was that benefit to reopening that we saw occur much earlier in Western economies. All of it is now coming back down. And the most recent set of numbers released just yesterday showing manufacturing dipping ever deeper into contractionary territory. All of this broadly telling this story. A global economic slowdown is in progress as we speak, and the markets apparently believe that it will be enough to bring inflation from 4.4 or 4.9, so closer to 5, down to 2. That's our stage setting. With that, we look at the numbers that are due here over the next 24 hours. The ISM manufacturing index is on deck. It is expected to give us a bit of a downshift from 47.1 to 47. So again, deeper into contraction territory. If we look at what's expected to happen on the inflation side of things, very tellingly, that index seen dipping. So a bit of disinflation with the slowdown, just as we might expect. Now, leading into this was the Chicago PMI number that we saw here released earlier today, and hat tip to Market News International. This is something from their index and their report that they produced earlier today. Notice where we are here. So if we look at where this is and where this is and where this is, we can see that we are at this point not exactly confirmed for a recession, but the levels of business activity where we find ourselves seem to be consistent with where recessions occurred before. That's these gray areas here. Obviously, this is back in 08, around the Great Recession. This is COVID right here. So what we are looking at is seemingly a situation where we have already the makings of something that looks recessionary ahead of this data. So if in fact this is where we're going, then we might expect something analogous from the release that's coming up. At the same time, however, U.S. economic data has tended to perform a bit better than expected overall. So you can see here there seems to be a bit of a turn in this city economic surprise index. This is a gauge of economic data as relative to expectations. I've put a 20-day moving average on here so we can just get a sense for the trend overall. And we can see we've started to trend higher, beginning with the PCE number that came in a bit higher than expected on Friday, and notwithstanding the Chicago PMI number that we saw today. This gives us an interesting set of circumstances and an interesting sort of place that we find ourselves. Let's go back to this chart that we've been looking at to kind of gauge where the market thinking is on this, and then what we can expect if the data is higher or lower. In the yellow bars is the S&P. In the red is the expectation for where Fed policy is at the end of this year. So that's the rate implied into Fed funds futures for December of this year. And there's a few phases we can see here. So over here, we're in an environment where U.S. economic data is good, rate expectations are building, and risk doesn't like it because it's a higher hurdle rate on investment, as we've just been saying, a higher hurdle rate on economic activity. And so what we have then is a negative response from risk. Then the SVB episode kind of shakes up the Etch-a-Sketch, and we get into a different sort of environment where normalization from these crisis levels gives us a parallel rise in policy expectations and risk, where this is not so much about, oh no, the Fed is going to over-tighten. It's more, we won't need as many rate cuts as were priced in here after this collapse, because this banking crisis does not seem to have found much contagion, at least so far. It has seemingly been episodic for now. And so what we end up with then is a rebuild and an erasing of the rate cuts that were priced in here, as relative to here, of course. And risk is rising at the same time because, of course, that more benign banking crisis story is good for stocks as well. There is a brief period right here where it seems like we're focused on the business cycle, where we top out on the recovery in rates, we top out on risk. Then we get into this debt ceiling conversation in May. And as we've talked about here, it's very telling that both risk and Fed policy expectations were moving up at the same time through that whole story. Because what that tells us is the markets through the course of May were increasingly becoming convinced that there is no way that this deal doesn't get done. And that it's going to get done with some amount of fiscal policy adjustment, but it won't be something that is a meaningful fiscal drag. I think the main concern with the debt ceiling was certainly not a U.S. default. We made this point strenuously yesterday and in past shows, because, of course, the pricing in of a U.S. default is impossible. It's a ludicrous thing to price in. We wouldn't have financial markets if the faith and credit of the U.S. government were somehow undermined in a critical way. Because, of course, the U.S. Treasury bond is the risk-free asset baked into the market structure. The U.S. dollar as the transactional currency of choice is baked into the market structure. There is no alternative to the U.S. dollar. There is no alternative to U.S. Treasuries as a risk-free asset. And in any case, moving from any sort of setup that we're familiar with now to any sort of setup that would de-emphasize the U.S. Government bond as a risk-free asset and the dollar as a transactional currency, that kind of a transition, if it were to happen quickly, would essentially make markets as we know them today cease to exist in a hurry. So that's obviously not what we're looking at here. It would be an impossibility to price that into markets as they exist, because it would fundamentally alter market structure at its most baseline way. So the thing that people have been speculating on is certainly not that, in my mind. It's how much of a fiscal headwind to growth are we going to get out of whatever debt ceiling deal? Are we going to get a lot less spending in the bargain? Are we going to perhaps get higher taxes in the bargain? And if we don't get a deal on time, do we maybe get a pause in government outlays that ends up hurting growth? Because, of course, government spending is an input into GDP. It looks like we spent all of May diminishing worries about those risks in the price of assets, cutting those losses down or cutting those worries down, because what we have is a parallel rise in stocks and in Fed policy expectations, basically saying we're not going to have a big fiscal headwind to economic activity and thereby earnings and thereby equity valuations. And the Fed is not going to have to cut rates in a hurry to offset a debacle on the fiscal side. That won't be necessary. There won't be a debacle, at least any more of a debacle than we already have now. So the question now is, with that bit settled, are we going into an environment where we are more so here or more so here. So if we get ISM data that echoes this and ends up being better than expected, is that good news or is it bad news? Is it good news because it means the business cycle is not in as bad of a place, at least in the US, as the expectations are pointing to? Or is it bad news because it means more Fed rate hikes? So are we here or are we here? So essentially, are we post SVB in the way these things interact or pre SVB? And it's the same story for the US dollar. Notice, before SVB, it's going up with Fed rate hike odds. It is being buoyed by higher rates and the excess return there is to be had then on dollars by way of yield differential relative to other currencies. Post SVB, which is here, there is that brief period where the dollar gets its haven rollback, and you can see that as policy expectations cool, ostensibly around this same narrative that we're talking about, the dollar has perked up all the same. This is a haven-minded dollar. Then as we get into the debt ceiling conversation, we again see these things moving in tandem. Again, because the markets seem to be pricing out the risk that this is going to go sideways or be some sort of a disorderly crisis level situation. So again, if the numbers are worse than expected versus better than expected, which world are we in? Well, if Fed rate expectations, given the 2-year break even showing us on target, are about right. If the market is saying the Fed doesn't need to do much more than what they've done already, there's one more hike baked in between June and July, but that's it. We're going to 2%. There will be enough economic weakness to get us there. Well, then we are in a world where bad data is bad and good data is good. Because we are not so much speculating on whether the Fed will deliver 25 basis points more at the meeting after the mid-year ones in June and July that are already baked in. That's no longer the object of speculation. The Fed story seems all but done at that kind of granular meeting-to-meeting level. Instead, we're looking at the business cycle and how badly the economy has to hurt in practice for this adjustment to occur. And so if we get a number that's disappointing, then we probably get weaker risk, we get a weaker view on Fed policy, but perhaps the dollar goes up. So we end up in this part of the story, where the market gets done with the banking crisis normalization, but hasn't focused on the debt ceiling yet. So we're back to, call it, the second half of last month, second half of April. There, as we would be here. And if the data surprises on the upside, similar story, where risk probably does well, where the outlook for Fed policy maybe does a little bit better. And then the big question will be that of the US dollar. Does it then come off a bit? Do we then get this dynamic in reverse? Or do we nevertheless find dollar support and it manages to still give us more of this? And that will be the main sort of scenario, one way or the other, that we might see. And that is macro money for today. We'll see how this data comes out and what it does to move these markets, which of course will be a great window into how markets might respond to the larger piece of news on Friday, the payrolls report, the unemployment data. But we'll catch up with that on Macro Money tomorrow. Do join us for that. I am here Monday through Thursday for this show, right after overtime, where we go over that particular day's events and discuss how markets did and why they did it. That's with our friend Chris Vecchio, head of futures and Forex, here at Tasty Live, also Monday through Thursday. I'm back on with Chris on Fridays for Futures Power Hour, on with Tom and Tony for First Call on Sundays, and outside of the shows, I am opining on Twitter at Ilya Spivak. Thanks very much for joining, everybody. Good luck trading out there. See you tomorrow.